Welcome everyone, and welcome to our end of July edition of On Track. Rob McGregor here, and reporting performance on all the portfolios and markets up to the end of July, and news and charts and everything right up to the date we're recording, which is the 25th of August 21. And what a crazy world it's been. Lots going on, lots to go through. Let's get into it. So first of all, this video is produced for clients of McGregor Wealth Management, particularly those using the CARE methodology, CARE process and CARE portfolios. Anyone else who comes across this, you're welcome to listen, but please seek advice on anything we talk about before acting. What we're going to cover today, going to have a look at some of the latest economic news, put it into context. It's hard to get past the main news again, which is always COVID. We're going to look at what that's meant for markets. We're going to have a look at the portfolio returns, vaccination race. We're now in a hurry. We're going to talk about that progress both here in Australia and around the world. I'm going to have a look at inflation, interest rates, and how they impact the valuations of shares and how they impact the valuations of property, what that means for you and your portfolios. And I'm going to have a look at property in particular. Population growth, one of the key drivers of property, and where population growth is going. We've all just done a census, so the data I'll have will be old, relatively old data, but we look forward to the census data coming out and being updated. So I'll talk more about that. And as always, my goal with this is to put the news in perspective to help you make smart financial decisions. So let's have a look at that news firstly. And we've got lockdowns continuing at the time of recording. Both New South Wales and Victoria in total lockdown. That's a massive proportion of Australia's population, and that's having an impact on the economic figures. It's highly likely that for the quarter we're in, which will be the September quarter, we're going to see a downturn in GDP of about -4 to -5%. So what does that mean? It means in that quarter, Australia produced collectively 4 to 5% less than we did in the previous quarter. So if we made $100 in the June quarter, we only made 95 collectively. And you can see that in the graph in the middle here. And you'll see that Australia, which is the light blue line, we came out of COVID better than any other economy in the world. We were actually back ahead, well before Europe, well before the States. But what we're seeing, and I'm going to talk about this pattern a lot, countries that did badly on COVID early are now doing well, and this applies to states as well, and countries that did really well early, like Australia and New Zealand, are now doing badly on what matters now in terms of vaccinations. And you can see Europe that was terrible early on in COVID is now, their economic activity is now back ahead of where it was pre-COVID. And predominantly that's because they are mostly vaccinated and mostly dropping of restrictions. And I'll talk more about that. And you can see that activity for Australia, the drop, the vertical pink or red bars here are the lockdowns in different states. And you can see that whenever there's a lockdown, it absolutely affects economic activity. So, and once again, it affects it at the margin. So what I mean by that, let me go through a few cases. If someone's a public servant, they're not affected at all. They get paid, they have some inconvenience, but no difference whatsoever. If someone's a casual worker at a restaurant that is now closed, they've just lost their job and they rely on the whatever handout is available. It's about $750 a week. That restaurant owner gets almost nothing. I was listening to something on the ABC yesterday, and it was about a guy who had an agri-business that created micro herbs and edible flowers. So those things that they sprinkle across on nice foods at good restaurants. And his business has gone from about $30,000 a week down to $5,000 a week because that stuff perishes in takeaways. So his business has been obliterated. He's had to put off 25 workers. Those workers will be getting $750 a week. He's getting no help whatsoever. So we can't stay in this state of lockdown. It's going to have a drastic consequence on businesses that are in that front line. There are many businesses, and I'd count ours amongst that are doing fine, that aren't impacted, but there are many that are right on that front line of travel and hospitality and live events that are doing terrible. And this is why vaccination is the only way out. We're starting to hear that, although we're hearing different messages from different states. And unfortunately, it's being politically aligned. We're going to see a lot of state wars in the next few months, unfortunately, whereas New South Wales, which has had to deal with a real outbreak, they pretty much have acknowledged that it's impossible to get back to 0 cases for them. And cases is the thing that they're not going to attempt to manage, but what they are managing is vaccination rates. And we'll see later this week, no doubt, announcements of more freedoms for people with vaccinations, not complete freedom. And then the national plan that when we get to 70 to 80% of people vaccinated, that we will start to open up, similar to what they've done in the UK. Now, in Australia, we're seeing a bit of debate about that from the states that have not had much COVID, Western Australia and Queensland in particular, versus those that have got it. But ultimately, the only way out of this is vaccination. And hopefully the politicians can put their politics aside and get on with it. In the non-COVID news, we saw the horrible side of the fall of Afghanistan as US troops leaving. And for those of us old enough, or at least to remember the news, it brought back similar parallels to the fall of Vietnam, another failed war. It is what it is. It's not pretty to watch, but it's going to lead to some interesting times. None of it's very relevant to markets, and I don't proclaim to be a international terror and political expert, so I'm not going to dive into that. Obviously, just big news, but it has almost no impact on markets except for any future terrorism that it may bring. On the good news, both in Australia and the US, there was a really good earnings season, and it's still continuing as we speak. So all that means is companies, as they're reporting their profits, the majority of them were actually either as expected or better than expected. Only a small proportion were less, not as good as expected. So that's good for the share markets, and that's helped to offset some of the good news. One of the big questions a lot of people have at the moment is, why is the market so healthy when we're in lockdown, when there's a lot of stuff going on? And I'll attempt to answer some of that throughout here. But part of that is the companies that are doing well are doing really well, and that is the majority of them. The ones that are doing badly are doing really badly, but as I said, that's only a proportion of companies. We've got property prices continuing to rise. We've got bond rates falling as inflation worries ease, even though in Australia, our latest inflation rate has jumped up. I'll talk more about that as we go through today. We've got vaccination rates climbing. And the interesting thing is, in places where there's lockdown, they're climbing rapidly. And in places where the lockdown stopped, they slow down. So we're going to see this two-phased country, unfortunately, which is where I suspect New South Wales and Victoria will keep up their vaccination rates. They'll get to that semi-freedom state. And you have other states, potentially in Queensland, WA, and even New Zealand, not their state of Australia, but in the same boat, with low vaccination rates, that won't actually be able to open up to those states. So we could be in for some interesting times. We'll talk more about that over the coming months. And we saw New Zealand locked down with 1 case, and they're now juggling about 16, but there's pretty much a whole country locked down, and certainly all of Auckland, over a very small number of cases, and they're going to have the same challenge now. It's becoming very clear Australia and New Zealand are kind of the only countries in the world attempting some sort of zero COVID, and it's not Australia as a country, but some of the states attempting that. It looks like it's just not possible, which means vaccination, learn to live with it, and get used to it is the only way out. Not much change in the key numbers. Interest rates still incredibly low. The 10-year government bond rate fell as inflation fears, so that fell from 1.2 down to 1.09. The Australian dollar a bit weaker, 71 cents, although I note it's gone up to 72 today. Annual inflation was one of the big news. So for the end of the June quarter, and there's a lag in the reporting on this, the annualized inflation rate is 3.8%. Now what that means is the June quarter went up, they multiplied by 4 to get 3.8. But it's probably transitory, and that means it's probably temporary, as this was sort of the opposite side of the spend on COVID. So we expect that to drop back, but that is the $1 trillion question. I'll talk more about that Mortgage rates continue to be low, as do term deposit rates. Term deposit rates at 0.3%. That means on $1 million, someone earns $3,000 a year. Quite staggering. So let's jump in. So the portfolio returns, to the end of July 30, extremely good and very consistent. Keep in mind, the 1 year still includes the full recovery from COVID. 3-year returns are more indicative, but those 3-year returns are great as well. And you'll see down the bottom here, when you line up next to our targets, the care portfolios doing what they're designed to do and ahead of schedule over 3 and 5 years, and very much ahead of schedule over 1, but acknowledging there was a negative year the year before. We rate the market still just a bit above fair value, in that fair to slightly expensive range. And I'm going to emphasize that slightly expensive, and that expensive is very much a function of what happens to interest rates. If interest rates stay low for longer, then markets are probably cheap. And that's the $1 million question. That's why in this episode today, I'm going to talk more about that. So we're not worried about markets. There is no alternative. And that just means there's always a high likelihood of a 5 to 10% correction in share markets. But that's normal. There's a likelihood of a 5 to 10% correction every single year in the markets. So don't forget our framework. Right now, we're quite clearly in the wall of worry and just a little bit over fair value. We're nowhere near a boom, which is when it is time to start to be a little bit careful to prepare for a potential bust, but we're nowhere near that. We're just a little bit above fair value. So no need to be thinking about big changes, but a good time to top up the coffers, potentially pull some out of the portfolio for those retired clients looking to buy cars or other things, but we'll talk about that in your individual reviews. Just reiterating, that cycle is driven by psychology, that pendulum that goes from fear to greed, and greed is just fear of missing out. So fear to fear, but one fear of losing, one's fear of not making as much as your neighbour. We're talking about new highs at the moment. So as the ASX 200 makes new highs, everyone's going, oh, look, it's back past where it was at COVID. But don't forget, the ASX 200 took literally nearly 14 years to get back from its previous high in 2007. So the number 2 biggest downturn in our modern history in Australia. The market peaked in 31st of October 2007. And for people that were reinvesting, it took them about 6 years to get their money back. For people that are drawing down on dividends, it took until literally January 2000. So January 2000, just before COVID, to get back to that level. So that was literally nearly 14 years. So even though we're at a new high, it's still not very far off the previous new high. So we don't think we're in lofty territory at all. All right, global vaccination rates, and I've put in a table on top of the global map. So to my friends in South Africa, apologies. But needless to say, South Africa's got the same low vaccination rate as most of the rest of Africa. You'll see the scale up the top here. So dark blue and light blue are very good. Look at Canada. Canada's got a vaccination rate of 74% of people received 1 dose, 66% of people received 2 doses. The UK, 62% of people 2 doses, 71. The UK's been open for business for nearly 5 weeks now. I'll talk about what's happened to their cases during that, but this is the way forward. The US has reasonably high vaccination rates, although it's very different state by state, and we're seeing different results there as well. Australia, we've just hit I think 1 dose, we're getting close to 50% now. Just be careful how people are measuring it. Depends whether they're talking about the total population or adult population. What's more important is the rise, but you can see Australia sitting in that laggard bunch along with New Zealand. Australia's better than New Zealand. New Zealand's only about 20% of people fully vaccinated. So that leaves them a long way from being able to open their international borders. And we're looking at New South Wales and Victoria probably hitting that 70% vaccination rate somewhere in October, but potentially Western Australia and Queensland, just to pick on those 2 states, lagging out to November or December. So we're going to see a real battle amongst the states, not to be vaccinated first, but over the language around lockdown versus vaccinate and get out of this. It's going to be very destabilizing. I expect the media to play this up a lot. and they're going to be pitching McGowan versus Gladys and ScoMo versus Anastasia. And it's going to look pretty ugly because we, the people, would like some clear leadership on this amongst our leaders. Don't expect it, by the way. And the only message, we can get angry on all this, but the only message is, we've got to follow the path of Canada, the UK, Europe, those countries where to get freedoms, to get travel back, to get some sense of normality, assuming we don't want to stay in a lockdown island forever, we've got to vaccinate to those levels. Or people, and that doesn't mean everyone has to, and I respect the rights of anyone not to for whatever their own reasons, but collectively, we do need the masses to get to that 70-ish% and then to learn to live with it. On the COVID numbers, and then I'll move on to markets, you'll see the top left-hand corner here, Europe. So you'll see the number of new cases, the dark blue line. So we've had this fourth wave that went up dramatically, but the red line, which is deaths, and the blue line, which is hospitalizations, haven't risen as cases have risen. So this is the future. When countries hit that 60 to 70% vaccination rates, COVID cases can rise, but we don't see a rise in hospitalizations, that's ICU, or deaths. And that's because of the stats around the viruses. So after 2 doses, this is what the stats look like. I'm going to start from the bottom, but if you've had one of those viruses, you're a 96% chance not to die from COVID. You're about a 50% chance not to pass it on, but you're still a 50% chance that you can pass it on. You're a 60 to 80% chance that you're not going to get any symptoms, and you're a 90 to 95% chance you're not going to go to hospital. So nearly all the cases in Australia, the vast majority, consistent with that 90-something% of hospitalizations from COVID, are people that aren't vaccinated. So that's the way to protect against hospitalization and death. It's not necessarily going to protect against spreading, but it is going to protect against people getting sick, and which allows us to move forward. The UK, very much the same. The UK, the first country to really release most of the issues. We've seen their cases go up, then actually start to drop again. But more importantly, hospitalizations and deaths at a level that is flat. Remember the start of COVID, we were talking about flattening the curve, and then it seemed to get forgotten. That is where we're going to get back to, but not flattening the curve of cases, but flattening the curve of hospitalizations and deaths from COVID. And we're seeing that in countries where they've got vaccination rates up. We're seeing it in the States, but the States is a mixed bag. Joe Biden, love him or hate him, talked about the pandemic of the unvaccinated. So moving from a pandemic of everyone to a pandemic of the unvaccinated. So hopefully you can see these colors here, but out of the 4 key areas of the US, that's the West, the Midwest, the Northeast, and the South, all of them are seeing less new deaths from COVID, except for one, which is the South, which is where the least people are vaccinated for whatever reasons that is. So massive differences between vaccinations and unvaccinated. And we're going to hopefully start to see the media, the politicians, the health officials focus on deaths and hospitalizations, not cases. Never before in the history of mankind have we focused on one event to the detriment. We're not tracking side by side COVID cases, mental health issues, economic disasters, all the other issues that are happening, people not going to hospital to report things because they're scared of getting COVID. We're focusing on one thing, which is always dangerous, and hopefully we'll see that switch to other things, and we'll get away from the daily briefing. All right. Just reiterating, the reason most people don't get great investment returns over time is because they mess it up, and that's these initials. The first 4, I've never ever seen so focused. We've got the media running rampant, trying to scare up trouble, reporting on short-term issues and single issues, which is all COVID, and driving people's emotions. We're going to see, I think it's going to get worse the next 3 to 6 months. I think the arguments between extreme people on both sides, and we see that with our politicians, are going to get worse, hopefully, before it gets better. So, I'll move forward. Just a quick reminder that care philosophy. At the moment, the key benefit comes from managing our behavior, us as investors, by avoiding bad decisions, not messing it up. The rest of it, we do well. We're seeing that in the results. And those results, by the way, put us above average in performance. We are below average in fees, which is always where our goals are. The care portfolios themselves are nominated as finalists in the IMAP Awards. That's the Institute for Managed Portfolios. That's for the second year running, so we're very pleased with that. We'll find out the next week whether we win that. We don't mind whether we win or lose. We just want to be up there all the time. And GPS Wealth, our group that we're part of, just won the Core Data Licensee of the Year. So just a little bit of chest beating there. So yeah, the market thinks we're doing well. Now I want to focus in, my main topic for this month is around inflation and interest rates and valuations of assets, particularly shares and property. So in the top left-hand corner, we see Australia's inflation rate going back to 1960. So with this spike in the 70s, when the oil crisis hit, where inflation got to nearly 20%, and then it took literally years to get it under control. It took to the late 80s to bring it back down to sort of below 5%. And what that meant is bond yields followed. So bond yields is just the return you get on government bonds and interest. So bond yields got as high, in the early 80s as 16%, and then slowly down towards the late 80s and 90s. So bond yields lagged a bit there. And as we speak, as I said, bond yields about 1%, which matches inflation, although inflation has just blown up to 3.8. We expect that to drop down back around the 2% mark, which would be acceptable. And bonds to probably slowly get around that 2%. That's also reflected in mortgage rates, which got as high as 17% in the late 80s. I remember paying that personally on my first home that I bought, and then dropping as these things dropped. So that's the interest rate side. So the important message here is interest rates and inflation are linked. If we get inflation back, we'll get interest rates back. $1 million question is, will we get inflation back? We'll probably get some back, and some back would be healthy, but too much like we had in the 70s and 80s would cause lots of financial instability. Not all losing, by the way, because companies that can increase prices with inflation, landlords that can increase rent with inflation do very well. In the 70s and 80s, if I go back, and if you look at the 70s and 80s where we had our inflation, it was the single best period for shareholders. So from the bottom of the market in 1974, when we had the inflation spike and markets dropped 50%, for the next 23 years, you averaged 20% from the share market. So even though inflation was high, it was a very good return. Property markets did spectacularly well as well. So inflation can be good for investors, but it creates volatility. So it can scare people out of the market, and anyone that's got debt can get pushed out of the market because of that high debt. So let's have a look at what that yield, so that interest rate means for valuations. So once again, we can see bond yields falling, and in the bottom left-hand corner, we see the yields on different types of property, commercial, industrial, retail, and this is for non-residential property, but for business property. So back in the 80s, you were getting a 12% yield on industrial property. You were getting nearly 10% on offices and shops. Fast forward now to the Sydney CBD market is around 4.25% yield. So what does that mean? So if a business was paying $50,000 in rent, that premises would be worth around $1 million. That's just 5%. Back in the 90s, that for the same $50,000 rent, the building would be worth only $500,000. So what will happen if rates go up quicker than economic growth and quicker than rents and profits is you could see a fall in those assets. Now, this is very complex, and it's important to note if rates go up, as they inevitably will, if they go up slowly and economic conditions are better, then there's not too much carnage. But if inflation was to go up quickly and sustainably, quicker than rents and profits, then you will see some turmoil in the markets to be recovered, because as I said, in the long run, higher inflation can actually be really good for people that own shares and property. And the same we see on the share market. So the top right-hand corner here is the yield on the Australian share market. So it's the earnings yield, not the dividend yield, but it's the profits effectively that companies make relative to the valuation. So going back to the 80s, that was high and it's dropped. There's some peaks that put it out of whack. One was in the GFC when profits dropped. So that meant yields spiked and then came back. And we've seen the opposite in COVID, where it's come the other way and coming back as well. But the line there is down. So the key message here is, as rates have dropped, we're willing to pay higher prices for shares and property relative to we've paid before, because the alternative of low cash. So quite logical when you think about it, and that's why residential property's gone up. It's why shares have gone up and stayed up. But it's why everyone's focused on the bond markets and inflation rates. And if that was to look like it was going to get out of control going up, you'd see some wobbles in the share market. We don't think that's on the cards in the near future, but everything's always on the cards in the longer term future. So let's have a look at the share market. So positive month for Australian shares to the end of July. It's come back a bit since then, which is probably healthy, and a cracking year, 29% in the share market. But important to note, that just brings it back to the long-term averages. Look at the long-term averages here, 3, 5, 10 years, 30 years, long-term historical, all around 9-10%. So that's what shares have done for the last 100 years in Australia. So we're not at a crazy place where the market's doubled really quickly. US shares, they're a bit higher, so 35% last year. The last 10 years, they're actually averaging 20%. Now, keep in mind, this is the returns to us in Australia. So the Aussie dollar comes into play here, but US shares have run much stronger than Australian shares. That's partly due to their high concentration in tech. And if you look at the US share market, the top of the ladder, the usual suspects: Apple, Microsoft, Amazon, Facebook, Google, Tesla, and then Berkshire Hathaway, Warren Buffett's company. So predominantly tech, and there's been that massive growth in those massive, the companies like Apple and Amazon that have just become, and they're not necessarily super expensive either. If you look at a company like Google, then you can see on here the price earnings ratios. So Apple has a price earnings ratio of about 26. And while that's high, if you take the inverse of that, that's the equivalent of about a 4% yield. So when you consider cash and bonds are at 1%, it's not crazy. Google about 30. So for tech companies, they're not too bad. Tesla incredibly high, but that's the market basically saying they think they're going to grow. We'll see what happens. US small caps, phenomenal year. It was a comeback year. US small caps in the last 5 years have done reasonably well, not crazy. We do expect small caps to deliver better than large caps in the long run by about 2%, but it comes with more volatility, and that's why we have less in the portfolio. For most people, except for those at the young end of the scale. As investors, global leaders, so top 100 companies in the world. So once again, this is the Apples, the Microsofts, etc. Same story. They're in a high rate. We've sort of got to watch on global leaders and global small companies in our active portfolio, where from time to time we may take profits. We're not taking profits yet. We usually let them run for reasons that are pretty much about the fact that it's almost impossible to predict short-term movements. If markets get ahead of themselves, we do stand ready to take some profits and come back in, but we only do it if markets start to go down on some sort of bad news. We took a bit of profit out of small companies during the COVID crisis, but we only do it when markets are overvalued. So the only markets we think are a little bit above at the moment is those global leaders and US small caps in particular. The rest of the US market, the Aussie market, are much closer to fair value and very much fair to cheap if you consider low interest rates staying for a while. Emerging markets are very much fair value. Emerging markets had a negative month as the developing world is not doing as well with COVID. Main driver there. But these companies will come back in the long run. We actually expect emerging markets to do extremely well, and they're coming from a very much a cheaper base as well, in terms of a lower valuation. So emerging markets are an important part of the portfolio. Gold had a negative year. So while share markets are all around that 25 to 30%, gold minus 10. And that's because gold is kind of like the insurance policy. We think gold's incredibly important as an inflation hedge, as you can see in the bottom left-hand corner. And as we talk about the risks of inflation and interest rates, important to have gold in the portfolio. Let me just qualify while I'm there. We have no fear of our current holdings in the market. We think we've got an extremely well-diversified portfolio. Whenever we're trimming at the margin, and whenever we think the market's a little bit expensive, that just means we think there'll be some normal corrections on the way, but you never would try and time markets around those judgments that we make. And for new money coming in, you know, if someone has new money right now, we're spreading it over the next year. And if someone's got expenses coming up, we're saying not a bad time to pull some money out of the market. But for your long-term portfolio, it's just rebalancing, topping up the reserves as normal. So into the property market, and a wall of green. Yeah, everything up 1.5 to 2% for the month of July. That's bringing the year-on-year change up to pretty much 15 to 20% for the whole country now. And in some places like Noosa, it's as much as 40 to 50%. And as I spoke about last month, there are still some pockets, particularly around inner city apartments, that have had less than that. But absolutely crazy market. There's a chart here that I'm going to play. I'm going to switch to live here. There's this fantastic website. Let me see if I can get this. Bear with me while I get to this Australian capital city house prices from 1970 to 2020. This is a live chart. I'm going to hit play while I talk about it. So this shows median prices for the capital cities. So you can see Sydney on top in the blue, Canberra slightly ahead of Sydney for a while back in the 70s, and then Melbourne, Perth, and you can see them changing in different ways. I love watching this chart. We're going to watch it go through as I talk about some of the phenomena. So keep in mind, this time interest rates rising, but property prices still going up nicely. So inflation, interest rates through the 80s, property prices were going up because rents were going up and because population was growing and economic growth was there. Look at the numbers, 370,000 for Sydney, 250 for Melbourne, Canberra jumps back up again, Hobart right on the bottom, Perth at 200,000. As we get into the late 90s, just as interest rates started to get under control. So we had some good growth in property through that period. Sydney now knocking on the door and just about to hit the high 400s, 500,000. So Sydney hit the 500,000 mark just on the turn of the century, right about the time of the Sydney Olympics. The other states following, Canberra up there, not as much as Sydney, and Melbourne still very affordable relative to Sydney. And look at Perth coming through now as the mining boom started to take hold. Perth was from that low 250 to 400s and moving up really quick, and Perth just about catches Sydney. Right about now, which was right about 2000, Perth just about, and there you go. Caught Sydney, then starts to back off as the mining boom started to dissipate, and Perth had to suffer the hangover of the mining boom and their property boom. Sydney stays strong, Melbourne, etc., moving up again. Darwin, and keep in mind, Darwin's only got 200,000 people. We don't consider that a capital city property market of A grade. But Darwin almost got as high as Sydney as well, which was never going to last, and it didn't. And then you see Perth now, as Sydney's growing, we're only into 2011 here. Sydney's still growing, Darwin's still up there, Canberra's still up there, Perth's still up there, but not going anywhere. Perth peaked at about 600,000. And just maintaining in the 550 to 600,000 bit. You see Brisbane growing steadily up to 500,000, Adelaide growing slower, Hobart growing slower. That'll change as we get closer to today's. For those of you that are just listening to this, not watching the video, it's probably worth watching the video at some stage or logging onto this website, Australian Capital City Housing, on the public.flourish.studio. You can see it at the top of the page here. Sydney hits $1 million median in 2017. So from 500,000 Sydney Olympics to $1 million 2017. And spoiler alert, it's going to end up at about 1.3, 1.4. Melbourne now firmly in second place, occasionally interchanging with Canberra. Brisbane rock solid, just growing steadily. Look at Perth, back to below 500,000. So from that peak in 2007 of 600. So this only goes to June 20 and it's stopped. So you can see, you know, and right now, literally 1 year later, Sydney is at 1.3. Oops, I've triggered it again. I'll just jump to the end. Yeah, but what I'm saying here, and apologies, I'll get this right, and I'll pause it. Yeah, there's always markets. You know, we saw Darwin retreat from 600 down to 465, Perth retreat from 600 to 472. Adelaide pretty slow, Brisbane and Melbourne steady, Sydney now 1.3 million. So the key message there is there's multiple markets in Australia, so we still don't mind investment properties, very carefully selected at the moment for clients who are growing their wealth and who a bit of gearing is an advantage for tax. Now, Second part of that, it's driven by population growth. Have a look at the population growth here of the top two lines, Melbourne and Sydney. Melbourne's actually caught up to Sydney as we speak. They both have around, just over 4.7 million people. Absolutely huge. Go back to the 70s, they were 2.5 and 3 million. So phenomenal growth there, but growth in all the cities, including Brisbane in the green, Perth growing solidly. And then this is the forecast from the Australian Bureau of Statistics fairly recently, their base case. And this is post-COVID, but they do have a wide variety. So we may grow a lot more, we may grow less than this depending on immigration outcomes post-COVID. But Melbourne and Sydney hit to get to nearly 6 million and just over 6 million each by the end of the 20s as we hit 2030. So by the time we hit Brisbane Olympics in 2032, we're pretty much going to have 3 million people in Brisbane. That'll be 50% of the Queensland population, which will be about 6 million, and you'll have about 5 million in southeast Queensland, so Gold Coast, Brisbane, and the Sunshine Coast. Perth at 2.4 million. So all these cities growing. And if you think about the nature of that demographic, you go back to the 70s, and most households had 3 to 6 people in it. Let's call it an average of 4. Fast forward to today, and that average is closer to 2, and it's predicted to drop to 1 point something as more and more people live on their own or just as a couple, as opposed to bigger families. So all that is a positive for the long-term property. In the short term, interest rates will affect property prices. If we did see increases, dramatic increases in interest rates, that would hurt property short term, but the long-term story will remain solid. So the big points there for property is be very careful about your debt. Don't borrow more than you can afford to pay. Potentially look to lock in longer term rates for investment properties, but talk to us about individual strategies there. We're already talking to all of you that have those strategies in place. So a bit of information there. The Harron Todd White Property Clock has everything going up. I've never seen it before like that. It's talking about some maybe at the top, Canberra, etc., and Hobart, which have gone crazy, and some potentially at the bottom, but everything going up. That brings me to my usual conclusion, which is just saying our mission for you guys is to have an exciting life and boring money, not the other way around. And that's by having a plan, with a real financial plan where you've got your goals and the portfolio designed to meet that goals. We do take a long-term view. We're still very confident in the long-term future of good quality investments. As always, in the short term, there'll be volatility, but it's amazing how well investments have held up, partly because of that low interest environment. As always, diversify, 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 and make sure we're getting access. We make sure you're getting access to the right type of investments at a reasonable low cost. Protect against the short-term volatility by dollar cost averaging for our wealth builders and by holding enough in reserve for our retirees. And that's meant that not one of our clients has panicked or had to draw money out of a market while it's down, which is something we're very pleased about. We rebalance the portfolios regularly, both as an investment committee and also when we update your reserves and your portfolios every time we sit down for a review. And as always, only 3 ways to lose money. Don't do them. That's the panic and sell, that's the have to sell, and that's not properly diversified. There is no cause for panic at the moment, even though we have the markets at slightly above fair value. If we actually assumed interest rates were locked in for a long time at current rates, markets would be incredibly cheap. But the unknown about what happens to interest rates causes us just a bit of caution on that view. So have a great month. Watch the media sparingly. It's going to be a fascinating battle of the opinions over the next little while, and hopefully you're all doing okay. So until next time, wishing you a great day. Cheers.